There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a second to get us up to speed on the action from today's session. I'm going to start with where the major averages ended the session, all in the green by just a hair, just a whisker. The Dow up only about 10 points, 0.1% here. And really, we saw the major averages trade in a pretty tight range today and a little changed range today. Not a lot of macro catalysts, not a lot of new news on the tariff front, for example. We'll get Fed minutes tomorrow, but nothing enough to really push things in a very significant direction today. We had the same case with the S&P 500, rather. Finishing a higher, sort of taking a leg up at the end of the day, but still only up 0.25%. And the NASDAQ also peaking very barely into the green here, setting up for the rest of the week. And of course, we had off yesterday on the market. So the first trading day of the week here, kind of a little changed result. Jared, what are you seeing under the surface here?
Well, we got to talk about Meta. That will happen in a minute. Yes, pulled out a green close just barely in the major indices, but not a lot happening today, at least at the surface level. Here's the 10-year T-note yield. That was up 7 basis points. That's notable. U.S. dollar index also up a little bit, but nothing to write home about. So we just put that in the back pocket. And then we will look at the sector action. And today we have energy. That held out in the lead today, followed by materials. Then we got utilities, tech, industrials, financials. That is the top row there. So energy, number one. And then in the red, we have communication services, consumer discretionary, and then healthcare. All three of those in the red. Let's turn it over to the NASDAQ. I mentioned Meta down 2.76%. Worst day in several weeks. It was pretty close to the close. Worst day since December, but I think it managed to eke out some gains into the close, at least off of those lows, so probably not as bad as that. But it was supposed to be day 21 today, and in fact, it was up 20 days in a row, but that didn't make 21. It was a $66 billion market cap loss. That sounds like a lot, but in the grand scheme of things, I think that ranked 250 when I ran it through the Mag 7 loss engine, and that was number one was about $600 billion, and that was a few weeks ago with DeepSeek. NVIDIA, for its part, was up 0.4% today. It's inching closer to its record high, but not quite there just yet. I think it's about 5% off or so. And you can see, aside from some red and some of the bigger issues here, it was mostly a green day in the indices. And I got to show you what's going on with China. Going to do a deeper dive with Josh with you, Julie, in about 30 minutes. We have Pinduoduo up 3%, Baba up almost 2%, and some losses as well. But the juggernaut of China really picking up here recently. Also tech, unprofitable tech, that didn't fare as well today. I'll turn it over to you guys, Allie.
Jared Blicker, thank you so much. Well, the market kicking off a shortened trading week with muted moves. The S&P 500 closing at a new all-time high, though, but it doesn't tell the whole story of what's happening below the surface. Taking a closer look at index volatility, when you compare it to the dispersion index, which focuses on individual stocks, it shows them trending in opposite directions. Joining us now is Ryan Dietrich. He is Chief Market Strategist at the Carson Group. So, Ryan, what do you make of that interesting trading action? We were talking this morning about how the market, it's a bit of a paddling duck market, where it's calm right on the surface, but then underneath, there's some chaos brewing.
Well, that's right. Thanks for having me back, and happy new all-time highs for the S&P 500, one of the more boring all-time highs I think we've seen in a long time. It's interesting because, yes, we're hitting all-time highs, and we're up 20% 2 years in a row. Then we look at, and Jared just shared some of these numbers here. On the year, all 11 sectors are higher on the S&P 500. 7, at least as of Friday. I don't know today's data, but as of Friday, 7 groups are actually outperforming the S&P 500. So I think what's interesting is we look at these sentiment polls, and people are a little leery. Believe me, the scary headlines. We had the big drop in tech a couple weeks ago on AI concerns, so the sentiment's a little dour because people are probably a little overweight technology. But I think to put a bow on this, the reality is under the surface that duck might be pedaling pretty fast, but it's a really strong bull market. It still looks healthy to us. Maybe you're due for a little consolidation. That's okay. But to see the broad participation that's taking place, it's a great sign. I mean, last thing on this, the lifeblood of a bull market is to pass the baton around, right? And we're seeing that. We're seeing that baton being passed around. There's a lot of leadership. There's a lot of positives still out there.
But it doesn't feel like it, right? Like, am I wrong in thinking, you said it today, this was one of the more boring records that we've seen. I was looking at the AAII sentiment, which bearishness highest since November 2023. And I know that can be a contrary indicator, Ryan. but like it feels kind of meh right now to be seeing these all-time highs. Does that matter?
Well, I guess to someone, if they're investing, it maybe doesn't matter as much because, hey, all-time highs are all-time highs. But I'll build on that. Just about an hour ago, one of our Carson advisors reached out to me and said they've got clients that see the headlines. They see Trump might do this, or tariffs might do that, or taxes here and Fed there. And the headline risk is real. We're not ignoring the headline risk. A couple Mondays in a row, we know what happened with those big down days. But then you look back and we're earnings season, like you guys have been talking about all day. Earnings are really strong, all-time highs. But here's a really interesting one for you. During this earnings season, 8 of 11 sectors have seen profit margins also increasing. So you got strong profit margins, strong earnings, strong revenue. I mean, we can get more in the weeds of it, but that's why we're hitting all-time highs, and the headline risk is there, but it's nice and slow and almost kind of boring at these big blasts, like you said, Julie, of volatility on some down days, on some scary headlines. But, surprises in a bull market happen to the upside. I learned that a long time ago in my career. We're in a bull market, so maybe we shouldn't be that surprised. We keep chucking higher here.
You mentioned sectors, and year to date, all 11 sectors are in the green. Finally, we have this broadening trade happening, but it's still a very concentrated stock market. Valuations, particularly in tech, are still very high. At what point does that become a problem?
Well, I think a great question there. I mean, I think for tech, it maybe has become a problem. I mean, people don't realize this, I don't think. Last year, tech underperformed the S&P 500, not by a lot, just by a little bit. So far this year, tech once again is underperforming the S&P 500, but because that's where the pricey stocks are now. That's where a lot of growth is coming from. Let's be very clear. But how'd the Mag 7 do on the whole with earnings, right? They had tons of money, they made money, but the reactions were weak, right? So the bar was awfully high, but that's where, again, this rotation trade with financials doing well, with industrials. I know small and mid caps can be a dirty word sometimes, but they're starting to do very well. And just globally, right? We like the U.S. more than the rest of the globe. We've been saying that for 2 years. But all of a sudden, like Jared shared, I mean, you've got China coming back and Europe is really bouncing back. I mean, this broadening out theme is not just a U.S. thing. It is a global theme. And for diversified portfolios, those investors out there that have stayed tried and true to diversifying and rebalancing, you're really being rewarded because, again, tech might be coming back relative. That's not the end of the world. There's other groups that are doing well, and that's how bull markets work.
It's interesting that you bring up international stocks, too, because we were talking to Stephen Whiting from Citi at the top of the show, and he's not the first person to say this, nor are you. This has been this growing drumbeat lately that people should be looking outside the United States. But then how should people think about the tariff risk, the trade war risk, which we're thinking about a lot here, but obviously there could be a big effect elsewhere also?
No, you're right. And again, we have some international exposure. We're still overweight U.S., but I think the key concept here is the U.S. dollar. If the U.S. dollar breaks above the recent highs we had earlier this year, that's kind of all bets are off. The tariff concerns, whatever else is out there, the monster under the bed could be coming. But I know the dollar up a little bit today, but last week the dollar was down pretty big on the improving PPI data. We're of the camp, we're bullish, yes, over at equities, yes. We don't think there's going to be one cut this year. We think it's going to be more like 2 or 3. We think inflation is going to continue to improve, allow for the Fed to cut a little bit more than being priced in. That could allow that U.S. dollar to go lower. And let's be honest, look at history. A lower dollar is good for risk assets, but it's actually a little bit better for international stocks as well. A group that, again, we're underweight would be fine if they go up, but we still think there's a lot of opportunity. One final thing to add to this, international small caps, mid caps, they're all kind of the same family. If we see some outperformance in those areas, we think small and mid caps also should do very well from the United States in the U.S. here, and we like those areas as well.
And I want to pick up on your projection of interest rate cuts between 2 to 3 times this year. Obviously, that's ahead of consensus, and you believe that we will continue to see a deceleration on the inflation side. But what about on the growth side of the story? Do you think tariffs will weigh on growth? Do you think we could see a deterioration in the U.S. economy or in the jobs market that could potentially force the Fed to cut?
Great question. If we get massive tariffs, absolutely. It absolutely could do that. But we're not seeing that yet. I mean, I know the retail sales data that came out last month was bad, but just go outside. It's really cold outside. I mean, we still see a strong labor market. We still see a strong job market. Productivity. What did we see, I think 2 weeks ago now? A lot of jobs were revised lower, but GDP was actually revised higher. What's that tell us? Strong productivity. You go back and look in the history books, years with strong productivity tend to have better economic growth than expected. And usually the stock market sectors do really well. We've seen that for the last really 6 quarters now. Strong productivity. So that's a big theme we have on the Carson team. Strong productivity is going to lead to this bull market continuing to be stronger. And maybe to get specific to your question, there's cracks out there with the economy. Yes, the higher interest rates clearly are hurting the housing market. Manufacturing starting to show a pulse finally after a while. But the consumer, I know, again, one bad data piece with the retail sales, but I think there was some issues there. If we see more than one, then I'll be worried. But the consumer is still pretty darn strong, in our opinion.
Ryan, good to see you. Thank you.
Thank you.
Well, Meta shares closing lower today, meaning the win streak has come to an end. The stock closed higher for 20 consecutive days before snapping the streak today, down about 2.75%. No particular catalyst that I could see, Allie, that ended it.
But then
again, there wasn't really a catalyst necessarily that kept it going for 20 days.
Yeah, Jared Blickery highlighted a few interesting stats. The worst day since December 18th, which was a Fed day. $66 billion market cap drop ranks about 250 in all-time Mag 7 losses. So this just goes to show how much of a tear this company has been on since really the inauguration, I would say at this point. I remember who was at the inauguration, Mark Zuckerberg. Meta, the sole performer of the Mag 7 relative to the benchmark S&P. There seems to be this optimism around its AI strategy, maybe a clearer picture there. But I do wonder what really will be the future catalyst for this company, because we've seen them experiment with things outside of their wheelhouse before, Reality Labs, the metaverse, all that didn't necessarily pan out. Will that be a different story this time around when we think about the AI narrative and what a lot of these other hyperscalers are doing?
Yeah, especially considering how much that they are all spending this year. Meta shares, by the way, about 22% so far this year. As you said, it's the only of the Mag 7 to outperform the S&P 500. Let's get to some earnings results here. Bumble, the online dating company, out with its latest earnings reports. The shares dropping a quick 12% or so after the revenue outlook looks like is missing what analysts had been anticipating. So Bumble coming out here said that revenue was $261.6 million. That was ahead of estimates. EBITDA for the fourth quarter also coming out ahead of estimates on an adjusted basis, $72.5 million for that. But if you look at the company's first quarter outlook, it says it will make at most $248 million in revenue. That's short of the more than $257 million that analysts had been anticipating. And in the first quarter, it says its adjusted EBITDA will again be at most $63 million, whereas analysts on average had been looking for a little over $69 million. So the outlook appears to be what is sending those shares down.
Yeah, we've seen that with a lot of companies, right? If you miss on outlook, if you miss on that forecast, that's going to be, a punishment to the stock price. I'm curious on the earnings call and digging through the earnings release, what they're attributing that miss to. We've been hearing from a lot of companies that a stronger dollar, if they're more exposed overseas, that could potentially be weighing on the outlook. But Bumble, it's an interesting story, right? They introduced that Premium Plus subscription tier a couple years ago that was expected to support revenue growth. And to that point, paid subscribers did meet estimates in the quarter. But from an analyst perspective, it seems like a lot of folks are on the sidelines. Only 4 buys, 1 sell, but 16 holds. So perhaps more that they want to see from this company.
Yeah, and the shares are down 40% over the past year here. So we'll get some more details on the call, presumably about, as you said, what's behind that outlook. But the company's current CEO, Lydia Jones, talking about Whitney Wolfe Herd coming back to the company, and also talking about a product roadmap for the year ahead that should, hopefully for them, improve the performance.
Yeah, shares right now, escalating losses, down about 17%. Stick around, much more market domination overtime coming right up. The Trump administration has said it will keep using guidelines adopted by the Biden administration to review proposed corporate mergers. Yahoo Finance's Alexis Keenan joins us now with more. Alexis, it's not often that you hear the Trump admin is keeping something from Biden.
Yeah, they're going to keep it. And this came in a post from FTC Chair Andrew Ferguson saying he told his staff that these guidelines from 2003, that's when they were written and accepted They're joint guidelines, FTC, DOJ, and it's guidelines for how they evaluate M&A activity in the United States, right? So this is Ferguson saying here that that is important. It's going to provide a framework for the FTC and DOJ's merger review analysis. And he said it's important for stability, that this is building on prior law, it's building on the prior guidelines. And so kind of a surprise, but on the other hand, you had this kind of wait and see kind of look at, from legal experts, look at what the FTC was going to do, because certainly the Trump administration was pretty aggressive in M&A enforcement compared to Biden. I think that it sometimes can seem like because Lina Khan was chairing the FTC before Trump's administration, that there was some ultra aggressive push. There was in some respects, but when you take a look at the numbers, you have in the first, and the numbers don't shake out with perfect years with perfect data. However, when we did an analysis at Yahoo Finance back in November, we found that the first 3 years of the Trump administration had 118 M&A challenges versus the first 3 years into Biden's had 108. Doesn't change that Biden had a record-setting year in 2022 with 50 challenges brought, but it just gives some perspective there. So why are we not a little bit surprised that these new guidelines are being continued on? Well, you had some antitrust experts saying that they expected this pressure. For one, you had Trump tweeting about it on his Truth Social after the election, saying that big tech had run wild for years, that he was proud to have enforced antitrust in his first term, and he wanted to continue doing that. And also, if you look at the changes, they're pretty significant, though it's really about the way that mergers are looked at and what the thresholds are for the agencies to even decide to bring a challenge. One big thing is the way that the thresholds are balanced for presuming a merger is unlawful. That threshold was lowered, and also what's new in there is an actual percentage figure where the agency, the FTC, for example, will look at a combined merger and say, well, if it would sweep up a 30% market share once those two firms were combined, then we're going to presume that that is anti-competitive and we're going to take a harsher look. Also, things like considering how the labor market will be impacted, that too now can be considered along with a host of other changes. So this is Ferguson stepping out and saying, well, this is more of this could be expected. But again, maybe a little murky. He said it's a framework, and these are discretionary rules. They are not legally binding. So take it.
So they have some wiggle room, in other words. But it is fascinating considering how many people we've had coming on the show saying that the regulatory environment will unlock more M&A activity, maybe announcements, but then we'll see what happens at the regulatory level.
Yeah, and you had Trump already going after the HP deal for Juniper Networks. So right out of the box, he was showing some aggressive enforcement there.
See. Thanks, Alexis. Appreciate it. Well, breaking news, a federal judge denying a bid to block Elon Musk and Doge from accessing systems at several federal agencies. This coming as Musk says he wants to root out fraud at the Social Security Administration, raising concerns about Trump appointees gaining access to sensitive data. Washington correspondent Ben Warshkel and senior columnist Rick Newman join us now. And I was just glancing over the judge's ruling on this, where he basically said irreparable harm has not been done. What do we know? I guess let's start here with Social Security, Ben, and what Elon Musk has been doing inside that agency.
Yeah, so the Social Security piece of this is the kind of latest move from Elon Musk and his Doge team to kind of go agency by agency and access really sensitive data. They started at Treasury, the IRS, the Labor Department have been sort of precursors to this, and then Social Security was confirmed over the weekend. What it led to was the acting head of Social Security to leave the agency and be replaced by another career official while Trump's pick kind of works his way through the Senate confirmation process. But it sort of gets to this harm question of Musk having access to this data, and no, there haven't been any delays in payments or anything like that so far. But it sort of raised a lot of alarm bells here in Washington on sort of what he wants to do with this and whether he really needs this access to do what he wants to in terms of rooting out waste and fraud.
And Rick Newman, I want to bring you into the equation here because you have a new column out about how Musk could fix Social Security if he wanted to. So what are the details there?
Well, Social Security needs some work. It's not in terrible shape. Medicare is a thornier problem. That's the healthcare program for retirees. But basically, more money is now going out of Medicare in benefits than is coming in. I mean, we just kind of have a demographic problem there that needs to be addressed. I mean, this gets headlines every year when the trustees of the program put out this report. It's supposed to, the trust fund is supposed to run out of money around 2033. So that doesn't mean all benefits will be canceled, but it means that there's no surplus funding. So it's just going to get funded as the money comes in. And that would mean about a 20% cut in benefits for everybody who's enrolled in that program. 2033 is not a million years from now. That's 8 years from now, and that could get worse if there's a recession. So that needs to be addressed, or people are not going to get their full Social Security benefits. Elon Musk could rally some support to address that problem. That does not seem to be what he's doing. He's going around looking for fraud. I'm sure there is a little bit of fraud. I mean, news to Elon Musk and everybody else. The Inspector General at the Social Security Agency does audit that agency regularly, and they say improper payments account for something like 0.8% of all the money that goes out. So there is some fraud there. It's not huge. It's probably less than at Musk's own companies, but Musk is looking for much bigger numbers. So that's what people are so concerned about.
And another headline that crossed today is the Trump administration planning to cut 40% of Federal Housing Administration staff. The FHA is among one of the largest mortgage insurers in the world. And we've been talking a lot about Doge and a lot of the government cuts that we've been seeing. So Ben, what do you make of that? And what's been the word on Wall Street when it comes to what Doge has been doing?
Well, 40%, I mean, sounds small to me considering some of his other cuts. The other number you hear about the Consumer Financial Protection Bureau is 95%. They're trying to cut that. My point here is that they are trying to kind of do deep cuts across it, from mortgages to consumer protection to potentially the IRS and other agencies that they're going through one by one. So yeah, I think the reaction here is that these are deep cuts they're aiming for. The kind of judge's ruling and the legal challenges that we started this segment with, I think, point to the question of how far they're going to be able to go.
Well, and on that question, right, so this judge ruled this, but there are multiple challenges, right, Rick,
Yeah.
and Ben, to what's going on. So do we even know how many legal challenges there are at this point? And even though this one didn't succeed, presumably another one could have a different outcome with a different judge, I guess?
Well, Julie, I think you've said that the judge said there's no evidence of harm yet. And I think that's what everybody's waiting for, to see some evidence of harm. I think it's inevitable there is going to be evidence of harm at some point. Probably if you're a federal official who got laid off, you feel harmed. But, I mean, the most important question here is whether some guy, the so-called senior advisor to the president, an unelected person, can just go around canceling funding that Congress has legislatively approved. I mean, Congress is the part of the government that says, here's what gets funded, here's the amount, here's more or less how the money should be spent. And it's the executive branch that just executes what the legislative branch tells it to do. So what Musk and Trump are doing is, I mean, at some point they are clearly going to be basically abrogating the responsibility of Congress. And that's going to be what this really hinges on. Can they just go agency by agency and say, Congress said to spend this money, but we're not going to do it? That's the fundamental thing. I have no idea how it's going to happen, but it's a giant experiment in how our government works.
It is. We'll see how that experiment turns out. Ben and Rick, thank you very much. Appreciate it.
Talk to you later.
And by the way, you can scan the QR code below to catch Ben and Rick every week on their podcast, Capital Gains. They talk about all this kind of stuff in much more detail. That airs Fridays at noon Eastern. It is time now for What to Watch Wednesday, February 19th. Let's start off on the earnings front. We'll be getting reports from Etsy, Conagra, and Carvana. Etsy announcing results for the fourth quarter before the opening bell, and analysts expect the e-commerce company will face consumer spending headwinds despite efforts to expand its buyer base.
And taking a look at the Fed, some more Fed commentary coming tomorrow from Fed Vice Chair Philip Jefferson. This coming after comments earlier today from San Francisco Fed President Mary Daly. Daly saying that Fed policy should be restrictive until inflation falls. Also coming out in the afternoon are the minutes from January's FOMC meeting. That gives us more insight into the Fed's decision to hold interest rates steady last month.
And moving over to housing, we'll be getting some fresh housing data in the morning with housing starts and building permits. Economists forecast starts will drop compared to last month to an annual pace of 1.39 million and permits to decline to 1.46 million.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.